Yeah, we changed our view today, and that was on the back of, very importantly, Jay Powell on Wednesday signaling that we are likely to get a rate cut in September. We still have had fairly strong data with GDP growth in the second quarter at 2.8. We had retail sales for June at very strong levels. We'll get new numbers for that for July next week. We'll also get CPI inflation next week. But importantly, if you look at the high frequency data for daily data for how many people fly in airplanes is still strong. How many people go to restaurants is still strong. If you look at the IRS tax withholding data, it's also strong. Weekly data for retail sales is strong. Hotel bookings are still strong. Across the board, the weekly and daily indicators are still signaling that things are fine. So the bottom line is, yes, with this employment report, things are a little bit weaker, and it does fall in line with what Jay Powell was saying on Wednesday. So that's why we do think that we will now get a cut from the Fed of 25 basis points in September.
So what I'm hearing from you is that the sky is not falling by any means, Torsten.
Exactly. So let's just take a step back, and this is really, really important. And you and Carol have talked a lot about this, namely, what is the reason why we should have a recession now? What should be the source? It's not like in 2008 where we had a major bank fail. It's not like in 2000 where we had a major bubble pop in the stock market. It's not like in 91 where commercial real estate was falling significantly. There is no major shock anywhere when you look at the data that is falling apart and therefore can justify why we should see a dramatic slowdown in the economy. So looking about the anatomy of what is a recession, if it normally is either an asset bubble popping, it could be some shock from the outside. It could also traditionally be that the Fed has raised rates too much. Well, if its rates have been raised too much by the Fed, then the Fed can just begin to cut rates. So that's why this whole idea that suddenly from Thursday to Friday, meaning from yesterday to today, that we've had a dramatic change in the economic outlook, I just don't see the justification for that. I still think that we have a soft landing and the market is overreacting to one data point, which, by the way, could also be driven by a hurricane. There's still a lot of debate about that, as you know, today.
Yep, could be a slow your roll moment kind of thing. Having said that, former president of New York Fed Bill Dudley wrote a Bloomberg opinion column last week. He said he changed his mind that the Fed needed to cut rates now. This was before the decision this week. Democratic Senator Elizabeth Warren, who is on the Senate Banking and Finance Committee on X today, said Fed Chair Powell made a serious mistake not cutting interest rates. He's been warned over and over again that waiting too long risks driving the economy into a ditch. The jobs data is flashing red. Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks. Is she right? So I'm assuming, based on what you just said, we don't need an emergency cut. There are GFCs and global pandemics, and then there is just another month of data in a trend line that has been showing a softening jobs market, right?
I think that's exactly right. Absolutely, Carol. I think that this is the trend line of the Fed started raising rates in March of 2022. Think about it. That's almost 2.5 years ago. And now we're beginning to talk about, whoa, this is the impact of the Fed raising rates. Okay, if that's the case, well, then, of course, we will likely have the Fed now beginning to cut in September, beginning to signal that they will continue to cut rates as much as needed. But there is plenty of room for them with the Fed funds rate at around 5.5%, still being able to cut if there is a need to get some support to the economy. So I still think, in particular, looking, as Jay Powell said on Wednesday, at the totality of the data, that yes, there is some weakness in the labor market here. Again, there's a lot of debate about how much of the increase in the unemployment rate is because of, again, weather, how much of it because of immigration. Are there some special reasons for that? And I think that the Fed is saying, let's take some time here and figure out whether this is something that is more pronounced. If retail sales really weaken next week, that's not what we've seen in the weekly data, that's not what you're seeing in the daily data, then of course we can begin to think about whether this is a more likely scenario. But this idea that sentiment in the economy has changed overnight, the way it did with COVID, we did, as you said, Carol, the way it did with GFC, is just not what's happening in this situation here. It is much more a slow grind. So it is slower, but not crashing.
Hey,